So, as this is a game plan, guys, we go through what we need to, and then at the break, you guys are good at this, and it's a good way to meet people. We'll see right before the break ends, we're going to line you up alphabetically, my last name, and I have your exams alphabetically, my last name. So we'll see if we can pull off this. They say it can't be done, but I know you guys can handle that, right? All right, so I'm confident that you guys can handle it. If there's a problem, you'll let me know. Sounds like a plan. All right, let's just talk about logistics of what we're doing and where we're going from here. In terms of just to remind people what at least I think we've covered so far to date. You know what is income? Code section 61. You know those things, or you got a taste of those things which are excluded from income. We saw those in the form of code section 102, 119, 132, code sections like that. Then we moved on and we talked about computing gains and losses, right? Computing gains and losses, section 1001. We saw for gains, they must be realized and recognized. We saw for losses, they must be realized, recognized, and allowed. And we saw that sometimes there's non-recognition provisions. We also saw, conversely, that sometimes losses are disallowed, right? Code section 165, right? We then moved on and talked about the implications associated with what is a capital gain, preferential rates, capital loss limitation rules, code section 1211, 1212, preferential rates, code section 1H. We talked about what is a capital asset, code section 1221. We talked about the holding periods, code section 1223. We talked about, aside from that, we talked about non-capital assets, in particular, code section 1231. So 1231 is better than capital assets because the gains. If there's overall gains, you get capital gain. If there's an overall loss, you get ordinary loss. You had to be careful, right, of the sub-hodgepodge, 1231A4C. You also simultaneously had to be careful of 1231C, the look-back rule for 5 years. We also then investigated three other recapture provisions, or three things to be careful. Code section 1239, sale to a related party, which ordinarily might have capital gain, but this would give rise to ordinary income. These are code section 1245, code section 1250. Things that you have to be careful about. How about regularly in practice? I keep reminding you, when you think of 1231, you should constantly, I know students often make this mistake, they forget to bridge the two. 1231, you simultaneously should always think of 1245, 1250. We are moving to a different area now. We left the issue of characterization. We move on to chapter 12, assignment of income. Before I continue with the new material, do bear in mind that the final exam is cumulative. Also bear in mind that the exam itself can be more heavily weighted than the midterm. So that being the case, for those who didn't do as well as they would have liked, there is an opportunity for redemption on the final exam. And I've often seen people who have grades that are less than stellar really turn it around in the final exam. So hopefully, and I've also seen people who've done well in the midterm and somehow, some way, mistakenly think they can rest on their laurels. You can't. You got to keep up the energy levels. All right. So, and I'm here. I'm not going anywhere. I will be around for the duration. So if you need my help, just remember to give me a call, send me an email, let me know. I'm happy to try to resolve your questions. Also, good idea, make sure you have a good handle on the information, because if you wait until the final exam the day before, it's not a good idea to shoot me 3 emails. I will try to respond to all 3, but it's hard to absorb. So my message is, if you have questions, make sure you really try to focus now on each facet of the material. Don't wait until the end. Any logistical questions? Any things that come to mind? All right. Now, I will say that there's a few of you who were able to attend the tax/murder mystery this past Saturday night, so it was a lot of fun for those who could attend. If you couldn't make it this year, maybe you'll make it in the future year. I see to hear you were here. Busto was here. I'm trying. Michael, you were there?
No.
Yes, he was a doctor. Yes, he was a doctor. We had suspects, and Michael was a suspect.
I was a butler.
He was a butler, but he did not perpetrate the murders. The year was cleared of all charges. So anyway, it was a lot of fun. Anyone do anything else interesting this weekend? It's hard, in my opinion, it would be hard to top tax plus a murder mystery. But now that I've dropped that gauntlet, anyone had a challenge to say they had a better time? Okay, Ashley.
I got engaged this weekend.
Oh, wow. All right, Ashley, needless to say, I know I speak for the class. Can you give us the story of how you proposed?
Yeah. So we have this one, every year we go apple picking together as like a tradition. So
By the way, how many years have we been doing this?
7. We've been high school sweethearts.
Okay.
So we planned to go apple picking Saturday, and he was freaking out about the weather, and he's like, we should still go. And it was my mom's birthday, so we were supposed to go on a birthday dinner, and I was like, I got my hair done, I'm not going in the rain. So we decided to go to like a winery/apple picking place, and our 2 friends like hit up there in the freezing cold, and they set up, he got like a sign that like, will you marry me, with like buckets of apples and pumpkins. And I walked over and I saw my friends, and I was like, what are you doing here? And then all of a sudden they're like, turn around, and we got so then all of a sudden he had like a fake ring box on the apples, and I opened it and it was empty. When I turned around, he was on his knee. And then I came home to a party of 60 of our friends.
Oh, isn't that nice?
So it was really awesome. I couldn't believe everybody's known since August apparently. So it was
It's a well-kept secret. All right, I have to say that's one of the few times
The righteous.
this may have Trump even checks, okay? All right, so anyway, during the break, if you want to pepper Ashley with questions, she'll have some more stories to share. All right, everyone ready? Assignment of income, chapter 12. All right. All right. You will notice chapter 12 has a lot of judicial cases. It is one of the few, if not only, chapters that you, quite frankly, may not, although it's always a good exercise, to bring the Internal Revenue Code. This is largely based on judicial opinions, okay, not so much the Internal Revenue Code. And another thing about this that you should bear in mind, that we are answering one question when we look at this chapter, and one question only. We are not looking at, is this taxable? We are not looking at, is it exempt? We are not looking at computing gains and losses. We are not looking at the character of the income. We are addressing a 3-letter word. That 3-letter word is, Diana? Say it again? Who, right? Who is taxed? Who is taxed? That's what, it's not a question again of how much, the character, all those issues. It comes down to one thing and one thing only. Who is taxed? And this is not the Abbott Costello who is taxed. It is a among the multiple taxpayers who is taxed, right? Now, in yesteryear, this issue carried a bit more weight. Why did it carry a bit more weight in yesteryear? Because in yesteryear, tax rates were higher, okay? Tax rates went up to a high of 70%, right? So in a day and age where our maximum tax rate is now 39.6%, assigning income has a little less juice to it. When tax rates went as high as 70%, right? Assigning income was more attractive. Everyone agree? So tax rates have played a role here. Another thing to keep in mind, that trusts and estates, yesteryear, and still today, are considered a separate taxpayer. Everyone agree? Trusts and estates are a separate taxpayer. In yesteryear, they enjoyed fairly low brackets, right? Because they were considered a separate taxpayer. If you were to open up the Code Section 1E, what you would find is Code Section 1E, essentially trusts and estates are taxed at a flat rate, the highest marginal tax rate. So it doesn't make sense, right, to assign income to a trust or an estate now, because essentially, if you look at Code Section 1E, they're going to be taxed at the highest marginal tax rate. Okay, actually, I'm looking for your engagement. Okay. All right. The picture I'll circulate it to the class.
I'm not going to look until after.
Was it taxable income, Ashley?
No.
What's your authority?
Section 102.
Yeah, were you thinking that when he proposed?
Not that time, not that time.
Okay, just wondering. All right, so we have the relative rates are less progressive than in yesteryear. Secondly, we have the fact that trusts and estates are essentially taxed at the highest marginal tax rate. And in addition, we have the introduction several years ago of the so-called kiddie tax under Code Section 1G, where essentially unearned income of children are taxed at their parents' marginal tax rate, right? So essentially children under the age of 18 who have unearned income, their tax is at their parents' rate. So it doesn't make sense to assign income to a child, right? Unearned income, because that rate is going to be taxed, right, at the parents' rate. So there are some things that Congress have put in place, right, that mitigate against the assignment of income. But still, this is an issue that does come up with some frequency, not like something that comes up every 15, 20 years. Every few months I get some issues like this coming across my desk. All right, we start off, and notice, by the way, I will call attention that this chapter is bifurcated into two parts, okay? There's income from services, that starts on page 263. And just by way of bifurcation, notice on page 274, income from property, okay? We're going to see income from services versus income from property. All right, so let's look at income from services first. And we have the famous Lucas v. Earl case. So, Lucas, since you have a good portion of that name, you get the honors.
Earl decided to make a contract with his wife where they were going to share everything, including his salary. So he wanted to be taxed on only half his income, but the government said that.
Hold on, let's slow down. So everyone get this. We have Mr. Earl, who is going to enter into a contractual arrangement with his wife, where, just keep the numbers simple. He earns $100,000. $50,000 is going to be his income. $50,000 is going to be his wife's income. All right, everyone has a visual? Was this done, Luke, if you think, for tax reasons? Was this arrangement entered into for tax reasons?
Probably, yes.
You would think so, but when did the income tax come into being? What year? Just celebrated a birthday. What year? What year? 1918? No? Anyone else? What year did it come into being? 1913, right? Recently celebrating his 100th birthday, right?
Yeah.
All right, so could it have been entered into for tax reasons? Guys, Luca, could it have been entered into for tax reasons? Agreed?
Yes.
There was no income tax then, right? Also bear in mind, in the years involved in the 1920s, was there a joint tax return, guys?
No.
No. Okay, there's no such thing as a joint tax return. What year did joint tax returns come into being? A little factoid for this weekend's barbecue if you guys need some factoids.
86?
No, not that late. 1942. 1942 was the introduction of the first joint tax return. So just bear that in mind. So taxpayers, even married taxpayers, which are now more or less treated as a single economic unit, right? That was not really, that's something that evolved. That just didn't happen when the income tax came into being. Okay, there was no such thing as a joint return. But this was not tax motivated. It happened to work to the taxpayer's advantage though, because keeping in mind that there's no such thing as a joint tax return, right, akin to what we have. Here, you take the income of one taxpayer, and that income is going to be bifurcated, and assuming there was a progressive rate in effect in the 1920s, it's going to cause a reduction of tax. Everyone agree? So, having said that, what's the position of the IRS? What's the position, Luca?
The one who earns the income should be taxed on it.
The one who earns income should be taxed on it, right? The one who performs the services. And who prevails here, Luca?
Not the IRS, but
The IRS prevails, okay? The IRS prevails. And we get a famous quote, okay? At least in my world. And by the way, Lucas Fierro, put it on your top 10 list of famous U.S. Supreme tax cases, okay? Just like Welsh, well, we're going to see Welsh v. Halvering, Crane v. Commissioner. This is on the top 10 list of famous cases. Lucas Fierro, and in particular, the last line of the case. So it seems to us, the import of the statute before us, and we think that no distinction can be taken according to the motives leading to the arrangement by which the fruits are attributed to a different tree than that on which they grew. And from this, we have the famous fruit and the tree metaphor. And I guess actually this is appropriate because of the apple picking, right? So maybe your fiance was thinking, gee, they're going to be reading Lucas Fierro, and I'll have to do this in the context of an apple orchard. Okay?
Yeah, he hears me talk about tax so much.
That's great. That's, every relationship should be based on that. All right, strong foundation. All right, so we will periodically return, all joking aside, but I'm dead serious about it, apples and trees and whether or not the apples grew on the same or different tree upon which they grew. Okay, because you will see a lot of that throughout this chapter, and anytime there's a reference to, virtually every time there's a reference to the assignment of income doctrine, there's this repeated reference to Lucas Fierro and the fruit and the tree. Okay, so be forewarned, but that's what people do in practice. They Those in the know will refer to this. Okay, we're good for the famous Lucas v. Earl case. I have a Commissioner v. Giannini. Commissioner v. Giannini. What happens in this case? Mike, you look like you wanted to talk about it.
The taxpayer instructs a corporation to donate his compensation instead of receiving it.
Okay, so we have the president of the company essentially saying, before he earns it, he's entitled to a certain bonus on top of whatever this 5% the corporate profits, okay, that he's entitled to with a minimum of $100,000 per year. When he learned that he was going to get a certain amount, he essentially said, stop giving me money. Essentially, I don't want the salary. Okay, everyone have the visual? So picture if you were president of a company, you learn that you've earned a lot already, and that for the rest of the year, you really don't want the rest of the money. And Mike, what happens to the money he doesn't want?
I think he directs it to go towards a part of the university.
Be careful what you say and how you say it. Phraseology is important here. And there's a lot of people behind you. I don't know if you could. Can you type into Google, assuming you're logged in, if you want to search?
Yes.
If you put in Giannini and University of California, and anyone else see some other people with laptops there. Here's and Luke. I don't know if you can.
Yeah, Giannini Foundation of Agricultural Economics.
Yeah, is there a picture of a building? There's a nice building. It still is today. The Giannini has a whole foundation there and a building.
Yes.
Nice things, okay? To honor our taxpayers.
Colonial.
All right. So, having said that, what is the IRS position here, Mike?
I guess that he had control to dispose of it.
Well, the IRS position is reflected on page 269. Okay, 269, the second paragraph on page 269. 4 or 5 lines down, it says that a taxpayer, quote unquote, realizes income when he directs the disposition thereof in a manner so that he reaches the object of his bounty. That in the instant case, the taxpayer had a right to claim and receive the whole 5% of the corporation profit as compensation for his services, and that his waiver of that right with the suggestion to be applied to some useful purpose was a disposition thereof to render the taxpayer taxable for the amount realized in the tax year in which the suggestion is carried out. So from the position of the IRS, right, Mike, is essentially he pushed this towards the University of California, right? Let me ask you, is the IRS being foolish here? Because keep in mind, whatever dollar amount goes to the University of California, does that qualify as a charitable deduction? Yes, right? Any monies you give, hint, hint, to Rutgers, charitable, right? It's a 501c3. What's my authority? Code section 170, right? So doesn't this seem short-sighted, Mike? Because if the IRS wins, can Mr. Giannini just say, oh, you got me, okay? It's income to me, but again, they're offsetting dollar-to-dollar deduction. Alicia?
Well, he will have to pay the taxes first, so IRS will collect taxes.
Well, if the IRS argues and says, listen, you have an extra $100,000 of income, and you say, okay, I have the income, but that same year $100,000 went to charity. Don't you get an offsetting deduction on your tax return? Say again?
Is there a limit on the deduction?
Alicia points out, there is a deduction limitation, right? You can only deduct up to 50% of your adjusted gross income, right? And there's a 5-year carry forward. Now, I don't know what the rules were when this case was decided, But I presume that Mr. Giannini could not have gotten a dollar for dollar write-off, okay? So I'm just calling that to your attention because some of you may have scratched your chin and said, gee, the IRS wins, it's not going to win much, and if the taxpayer could get an offsetting deduction. I presume this is never spelled out, but I just presume the taxpayer could not get an offsetting deduction.
But you didn't report it as a deduction, yes, or something?
Well, he didn't report it because he never took it into income, that kind of,
So that's fine.
all right?
He never included it in the.
Right, you can't get a deduction if you don't include it. Right? And here's a line, I think I'm a little bit, I doubt if this is true, but the judge writes on page 269, on the paragraph that begins with the word now, on page 269, there's a paragraph that begins with the word now. About 6-7 lines down, there's a sentence that begins, so far as the taxpayer was concerned, comma, the corporation could have kept the money. Everybody see that line? Now, call me cynical, but do you think the corporation really could have kept the money? Or do you think Mr. Giannini would have said, look guys, hint, hint, I told you I wanted to go to the University of California. Again, I wasn't there, I don't know for sure, but I'm sure when he said, you know what, I don't want this money, it may not have been memorialized in the corporate minutes or a place that public, but I'm sure they wanted to please the boss, right? And they said, oh, you don't want this money, where do you really want it to go? And even though he didn't say it must go in my name for the Giannini Foundation, it just didn't get there by accident, right? Again, call me cynical, I doubt the company would have just kept the money. Who wins here though, Mike, notwithstanding my cynicism?
The taxpayer.
The taxpayer does prevail. Okay? Under the theory that if you say you don't want something, no one can force you to take it into income, right? In other words, if you decline something, and someone says, here, take this money, and you affirmatively don't take it, that's what this case stands for, our proposition. Right? We have a revenue ruling, 66-167. And this is somewhat similar, deals with executors' commissions. If you are named as an executor, as for someone's estate or an administrator or court appoints you, you're entitled to certain commissions. No one can force you to take them. As long as you waive them up front, you will not be taxed on them. Okay? As long as you waive them before you commence services, you will not bear a tax. However, if you start performing services, and let's say it's a $10 million estate, and the commissions are $500,000, and after you've earned them, you say, oh, I don't want them. At that point, that would be considered income to you, and then you, in addition, may have not only had taxable income, but then had made a taxable gift. So the message of this ruling is, if possible, if you don't want to get commissions for your services, waive them early in the process. Later in the process could prove problematic. There's a revenue ruling that follows. another one, 74-581. Suppose you work for an accounting firm and you give, Nick, you give a lecture, and Nick is part of your employment contract. Rutgers asks you to speak, and Rutgers is going to give you a $500 honorarium. But you must turn over that money, say you work for PwC. You must turn that money over to PwC. Is that considered taxable income, that $500?
No, it's not.
No, it's not. What's your authority?
This ruling, because I'm an agent of PwC, or an employee of PwC, therefore I wouldn't be taxed.
Right. You never had a legal right because contractually you forfeited your right before you even got it. Right, everyone see that? That's revenue ruling 74-581. Everyone good? All right, you want to do the problems on page 274? Executive has a salaried position with high rolling corporation, under which he earns $80,000 each calendar year. Who is taxed if executive at the beginning of the year directs that $20,000 of her salary be paid to her aged parents? James, who gets taxed on that? You want to be the parents, the 20? Okay, Ari, agree or disagree? I'm sorry? And what would you say? I'm sorry? D88? Just say it loudly because you're all the way back there.
I think parents.
The parents?
Yeah.
Jackie, agree?
Isn't it the executive?
And if you say the executive, what's your authority?
I don't know my authority, but I think it's, isn't it because she earned the income that she's taxed on it?
Lewis and then Luca?
Would it be Lucas, the Earl,
Making whom taxable?
the executive?
Right? Isn't the executive tax here? The executive earned those apples, right? If you earn the apples, you get taxed on the apples, right? You can't just hand the apples to your parents and say, oh, they get taxed. If they were as easy as that, right, that would be an easy way to thwart the progressive nature of our income taxes, right?
The 20,000 is just a personal expense then?
No, it's not a personal expense. Again, it's a question of who gets taxed.
Oh,
There's no personal expense here. So it's the executive remaining taxable on this money. And we have authority. Lucas, we are up. Who is taxed if executive at the beginning of the year directs that the $20,000 of her salary be paid to any charity the board of directors of high rolling selects? And then just look at question C simultaneously. Same as B, executive makes the same request for $10,000 per year bonus, which corporation is announced towards the end of the year based on services rendered during the year. So one is at the beginning of the year, one is at the end of the year. Jesse, Joanne, what do you guys say? Jesse, question B?
I think executive will be taxed.
Executive, question B.
Yes.
Joanne?
In the case that it was first decided that it was not going to be, that the money should go to the charity, would that fall into the idea of 66-167, where she's decided not to take the money, but then if she decides at the end of the year, then she will be taxed.
Let's stick with question B. It's done at the beginning of the year.
Then he will not be taxed.
Would not be taxed. Okay, not taxed. And Netta, you agree? Anyone have a difference of opinion? Matt? You there? No difference of opinion? Is there anything troubling about this?
The trouble is direct, the word direct.
Yeah, the word is, remember, Giannini, he didn't direct. Everyone agree? He did not direct. So this case is in some ways troubling or distinguishable from Giannini, right? Because Giannini, at least as described by the court, the enterprise could have kept the money. Here, there's direction which falls more with the IRS, the notion of the IRS that, hey, if you direct something, you control it, you realize that it's taxable to you, right? Right, so, not to make your notes confusing, perplexing, or the like, I think there's really no correct answer. I think you could make the argument both ways. Because here, under Giannini, you would argue if you were representing the taxpayer, yeah, this is close enough to Giannini, non-taxable was done at the beginning of the year. The IRS certainly can make a very good argument to say, you directed the money, this is distinguished from Giannini, all right? So I'm not trying to make your notes perplexing, but I think this is a gray area. It could go either way. I think by way of contrast, if you look at the next question. Question C, Katie, what do you say?
I said it was taxed towards the executive.
Tax to the executive,
Yeah.
why?
Just a $10,000 a year bonus at the end, and
So-
you could just direct it away.
What do you say it's more likely to be taxed to the executive in this case? Dick?
Services are performed. She knew she was going to do it at the end of the year, and she waited until the end of the year to actually.
Yeah, I mean, that's a bigger problem because remember, we had that revenue ruling that deals with executive commissions, right? We had revenue ruling 66-167 that says, hey, if you're going to waive them or waive income, waive it before you earn it. Because if it's after you earn it, you may be in a position where you're taxable on it, and then it may constitute a taxable gift.
With the bonus, you never know if you receive the bonus.
True, but it could be a bonus. Anna's point is you never know if you're going to get a bonus. But if every year historically they pay a bonus, where it's some sort of percentage of your business and you sort of know what's going to come in, Anna, it's not part of your base, but you know it, I think that's problematic. All right, again, I'm not purposely trying to make your notes equivocal or ambiguous, but just, tax is interesting because there's not always a clean, crisp answer, right, guys? And sometimes there's better answers. And in this case, I think the authors are strategic to show you problem B and C. B says, maybe you can say non-taxable. And problem C say, probably more likely than not taxable, right? All right, question D. Who is taxed as an executive? In her corporate role, gives a series of lectures on corporate finance at a local business school, pursuant to a contract with High Rolling, turns over her $1,000 honorarium to the corporation. And I know you know the answer to this because we just did this, right, Busto?
Yeah, it's revenue ruling 74581.
Right. The revenue on the ruling on the prior page, 74-581. Right? So in that case, it's not going to be taxable to the executive. Jared?
Question number 66-167, is that just applicable to executors doing a will?
Yeah. I think the principles you can extend to, anyone performing services.
It sounded like when I read it that it's saying that, okay, yeah, it's a good idea to do it to waive it up front, but then it also said could also be to an implied waiver by basically not paying the fees when you do the filings for the.
Well, I agree. I mean, you could have what's better if you're recommending things for a client. You want to be as explicit as possible. So sometimes clients forget to prepare these express waivers, so you say, oh, there's an implied waiver. That's second best, right, Karen? You're here to help your client so your client sleeps at night.
I saw that would be kind of a way to get over the bonus thing at the end of the year, be like, oh, okay, well, still say at the end of the year that I didn't want to waive it.
Yeah, but again, we're going with better answers, so I think it's problematic.
Okay.
Moving on to income from property. Helbring v. Horst, famous case. Helbring v. Horst is another famous case. Okay? And some of you, your parents or grandparents, okay, had bearer bonds, where the bond had a face amount, say, $10,000, and there was monthly interest coupons that you would literally pick off, and you could bring to a bank these little coupons for $100 each, like representing interest. And whoever went to a bank with a coupon could collect the interest income. Okay, that's how these bonds work. They were negotiable bonds with detachable interest coupons. Okay, and here we have a taxpayer who gave some of the interest coupons, I believe, to a child. The question is, who's taxable, okay, on the interest? If you give some of the coupons to whomever you wish, who remains taxable? The person who holder of the bond or the person who collects the money? Okay, that's the issue. Who's taxable? The person who owns the bond, the person who collects the interest income. So Zach, Louise, who gets taxed? What do you think?
I would guess the holder of the bond.
Louise?
Yes.
The holder of the bond?
Yeah.
Okay. There's some quotes that I think are nice ones on this, two in particular. If you look on page 276, the second full paragraph, underlying the reasoning in these cases is the thought that income is quote-unquote realized by the signer because he who controls the source of income also controls the disposition of that which he could have received himself and diverts the payment from himself to others as the means of procuring the satisfaction of his wants. The second full paragraph on page 277, the power to dispose of income is the equivalent of ownership of it, right? The exercise of that power to procure the payment of income to another is for the enjoyment and hence realization of income by him who exercises it. Right? So you're both right that, and by the way, not surprising, how does this case end? At the very end on page 278, the last line. When a gift of the coupons has separated his right to interest payments from the investment that procured the payment of interest in the donee has enjoyed the economic benefits of the income in the same manner to the same extent as though the transfer were earnings. And in both cases, the import of the statute is that the fruit, notice the word fruit, is not to be attributed to a different tree than that on which it grew. Long story short, guys, if this came out any other way, it would have possibly spelled the end of the progressive tax rate. Because if you could detach coupons, remember at the time there's no so-called kiddie tax, right? And you could hand these to your children who could then recognize the income whose tax rate might be 5% or 10% or 0. Okay? And for all intents and purposes, the gift tax we could ignore. you know, you could really, really reduce your tax burden, right? So what does Elbring v. Horse stand for? A very simple proposition. In the case of property, unless you give away the tree, you hold on to the tree, you will remain taxable on the apples, right? If you hold on to the tree, you're going to remain taxable on the apples. Lair v. Commissioner. Not as famous as the Lucas v. Earl or Elbring v. Horse. What happens in Lair v. Commissioner? Great.
With your tree analogy, if we sell an interest in trust or an interest.
So just give us background before you get to the issue. What happens here?
We sold their interest in income of property in a trust.
Okay, so picture, if you will, the taxpayer, just keep it simple. Wife dies, leaves her husband in income interest. Say the trust had $1 million. Says, to my beloved husband, he gets all the income from this trust for his life, and upon his demise, it goes to my children. Okay, everyone got it? Wife dies, leaves $1 million in trust, husband gets an income interest for life. Got it? Okay, so what happens next day? What does the husband do?
Sells the interest.
Does he sell or he gives it?
Gives it.
He gives it, okay? He gives it to his, I believe his children, okay? So his children now have the income interest. By the way, most trusts I know of are non-alienable. In other words, it's kind of strange that the father would have been in a position to give it away, but it did. It gave away the income interest, okay? What's the issue? Who remains taxable on that income, right? The recipient child or the father who had the income interest originally? Dave, who prevails here?
The son would be taxed.
Okay, in other words, the father would not be taxed. The assignment was effective. If you look at the top of page 281, please conclude the assignments were valid, that the assignees thereby became the owners of a specified beneficial interest in the income, and that as to these interests, they and not just the petitioner were taxable for the years in question. Right? So at the end of the day, this was an effective assignment because here the only thing Dad had was an income interest. He didn't have anything else. It was, the income was tied up to the tree, right? The fruit and the tree were one. He gave away everything he owned. He retained nothing. And as a result, the children were taxable, right? He had effectively given away everything. The state of Stranahan. Again, what are the authors trying to do here by giving us these series of cases? Just showing us how the assignment of income doctrine works. You can't do it any other way. You've got to do it by way of example. All right. Carrie, do you have a chance to look at this? State of Stranahan.
So apparently he had some big deficiency that he did agree to pay, that he didn't make enough income in that year to be able to net out the interest payment that he.
All right, so picture, if you will, this is important because most taxpayers, we learn, we know, like to minimize their income. And we know that, for example, Code Section 165 puts the brakes on allowing personal losses, right? Code Section 267, sales between related parties, not allowed. Code Section 1041, right? Losses between spouses, not allowed. Even gains, right? but the code is good at protecting against allowing taxpayers to manufacture losses, okay? Everyone agree? The code is pretty good at stopping taxpayers from manufacturing losses. The code is not very good at stopping taxpayers from producing income, okay? Because usually that's a good thing from a revenue perspective. This is one of the few times if you have expiring losses, you have taxpayers here, because we have a taxpayer singular, who has an expiring loss, and as a result, wants income because to the extent the taxpayer has income, it's not going to trigger more tax, right? Because the loss will be used to offset that income, all right? So what does the taxpayer do here, Karen, strategically to generate income?
He has a bunch of shares, like 12,500 something shares of this stock of the same company that trading sports clothes that able to work at. And he knows he's going to be giving, I guess, he can prove that whenever he's giving regular dividends. So he sells the dividend stream.
Okay, so everyone had this visual. Taxpayer owns company stock that historically pays X dollars worth of dividends, okay? In this case, over several years, pays about $115,000 of anticipated dividends, okay? And he sells those dividends, those right to dividends, future dividends, for how much? About $115,000, right? Or 122, I think it. He sells them for 115 because there's $122,000. So, in other words, because of time value of money issues, he gets the money now, but his son, who's putting up, say, $115,000, is going to be paid that money over the next several years. So, if you get the visual, wouldn't you want some sort of interest component on that? In other words, if you're going to pay for something and you have no risk it's going to pay you over the next several years, you're going to want more money, right? Because you want your money to, work for you, right? So he pays Dad $115 with the expectation of ultimately getting $122,000 of dividends, right? And the decedent reported, by the way, notice, just sort of gave away my question. This tax gain that the taxpayer, right? The taxpayer is trying to front load, right, $115,000 of income because he knew that he had equivalent losses essentially of that dollar figure, right? When I say tongue in cheek, he paid the ultimate price, right, for his tax gains. Notice it's the estate is threat of him. Okay, just sorry, good humor. Anyway, Karen. Was the taxpayer, everyone understand the game? Taxpayer wants to report $115,000 because by doing so, not going to pay a dime more in taxes. He's essentially selling the future right to dividends. The IRS's position is, on page 282, that this is essentially a loan. Like that essentially, this is not a taxable transaction. And for all intents and purposes, this was a loan by the son and not taxable income to the dad. But what is the court rule here, Karen?
Well, reverse the, and then we'll remand it. Well, that's the whole line of saying, you don't have to pay the treasury, but your goal should never be to pay the treasury.
Alicia was going to say something, and then Karen, I'll make a comment. Say it loudly, Alicia.
It was legitimate assignment of income according to the IRS.
Not the IRS, I mean the court. The court rules in the taxpayer's favor and says, look, this was a bona fide transaction. This was not some sort of strategy to minimize tax with the assignment of income. Personally, there's a number of academics who have critiqued this case and find it troubling. Thought the whole arrangement was somewhat like a sham. But here we have the state of Stratham for the proposition that you can engage in a legitimate sale. Remember, losses are disallowed right, between related parties, Code Section 267. But here there was a gain. And again, the code is not really well suited to stop recognition of a gain. So in this particular instance, the taxpayer was successful in recognizing the gain. All right. Next case. Salvatore, decommission. It's not a hard case to follow. Not a hard case to follow. What happens in this case? Jeff, you guys say?
So, Mrs. Salvatore owns a gas station that she's going to sell to Texaco, and the plan is to split the proceeds with her kids. And so, what she tries to do is to transfer the title to the kids before selling it to Texaco, so that when she sells it, the gain she gets on the sale, she reported half her piece as hers and the remainder to the kids. As
All right, so everyone get the visual on this. You have a taxpayer who, I think she inherited, right, the property from her husband.
Yeah, right.
Code Section 1014 applies, 102 applies, and some years later, she, with her kids' help, decides they're going to sell this enterprise, right? They're going to sell the gas station. And they figure out what mom needs for her future living arrangements. They decide mom only needs half the proceeds. And they decide, right, Jeff, that, and the Texaco is waiting. The contract is entered into, or about to be entered into, and they're going to immediately before transfer half the title to the kids. Mom's going to remain owner of half. Together, they're going to sell the property to Texaco, and the kids are going to report one half. Mom's going to be reporting one half, right, Jeff?
Right.
Everyone have the visual? Who prevails here, Jeff, and why?
The IRS says that it's all her gain, and the court agreed, the IRS, that it all belongs to her, because basically the whole deal, the sale, had been done before she transferred it to the kids, and also that the way that they came up with the money, with the amount of the mother got, they were kind of saying that they figured out what she needed and gave her her piece, so it wasn't really a split ownership of the property.
All right, so essentially, for all intents and purposes, mom had entered into this transaction, and immediately before the sale was consummated, essentially switched one half to the kids, assigned one half the income to the kids. And you can't do that, right? I mean, you can, there's no illegality to it, but under the assignment of income doctrine, it's not going to be respected, right? Everyone think, not surprising the outcome here, right? That if you have a deal in the making, about to be consummated, you can't, the day before, switch it up so you get taxed on one half and your children who are at lower tax rates. And just assume the kiddie tax, even if it was in the year 2016, if you have moms in her 80s, the kids are in their 50s or 60s, the kiddie tax is not going to apply. This will not work, right? And even though capital gains mom, the tax rate might be 20% to mom, the kids might have a 0, 15, or 20% tax rate. So this is not going to work. Now, let me just ask, Jeff, if this was gifted to the children 5 years earlier, okay, and then mom and the kids entered into this, would the kids have picked up half the gain? Would that have been respected?
I think so.
Okay, remember Taft v. Bowers? It's a case we looked at many moons ago in Chapter 6. And yes, the gifted in Code Section 1015, right? Remember Code Section 1015 where you have a carryover basis? Generally, thwarts or subverts the assignment of income doctrine. Everyone agree? You can give away property with embedded gains in it. Okay, and who picks up the income on those embedded gains? The recipient, right? Everyone agree? We went through that. So that does violate the assignment of income doctrine. The difference is when you gift it, if there's no sale on the immediate horizon, that's going to be considered legitimate, and the recipient picks up the gain. But if there's a sale on the immediate horizon, we have the Salvador case which says that it's not going to be respected. Everyone see that distinction? Here, you got that? All right. So for revenue ruling, 69-102. It is not the easiest revenue ruling to read. Right? And the takeaway of the revenue ruling, I'm a very bad drawer. You guys know my handwriting is not great. But picture, if you will, and I know actually this is not going to remind you of an apple tree, so I apologize that you saw on Saturday. Yeah, Saturday was miserable, weather-wise. Not in the day, of course. If you remember, the day was wet, windy, tough day, right? Everyone agree? And some of you may be familiar with a childhood book called 10 Apples on Top. Okay, maybe you do, maybe you don't remember that. But picture, if you will, that there are, this is my attempt at an apple tree, and there's 10 apples, okay? And the ones that are circles and not filled in, we got 4, 5, 6. We have 10 apples on this tree. 4 are ripe. Okay, everyone agree? 4 are ripe apples. 6 are not. Okay. This revenue ruling 69-102 stands for 2 propositions. That if you give away something, and we'll see this in practice, okay? So this is not something you're like, what did he just say? Okay, so you may say that for the next few minutes, but then we'll go through an example and hopefully everything will be clarified. If you give away a tree with ripe apples, you will be taxed on, okay? Okay, you will remain taxable if you give away that tree with ripe apples. When will you be taxed? When you give away the tree, or when the person harvests the apples? And the answer in this revenue ruling is? Say again, Alicia?
I would say when you give away.
But that's not the way the ruling says. As a cash method taxpayer, you only get taxed when the apples are harvested.
What if they're harvested a couple of years later?
A couple of years later, you're taxed then.
What if you're dead?
Your estate. I mean, the revenue ruling, let me see if I can pick out that language that says that. If you look at the flush language on page 290, the indented language, the cash method taxpayer is not taxed on income until he receives it actually or constructively. The making of a gift of his right to receive income does not cause the income to be received until the donor derives the economic benefit of having the income received by his donee. You see what it says? So it's not when you think. It's upon, okay, when it's harvested. Good news for you is most things don't, I'm into tax, I'm not into growing things. So Alicia, most things that are grown, and we'll see this with kinds of income, usually mature within a year, right? Most people will harvest fruits and vegetables. Is there any fruit or vegetable that takes more than a year to harvest? I don't know. You guys help me out there.
I know there's a flower that takes 10 years to bloom. It was blooming in the garden, the botanical gardens.
And I missed it.
It's
10
probably
years.
still there, it's gonna probably move for a year or so.
Send us a picture, we'll circulate it. It's 10 years, okay? Okay, but most things do not take 10 years, okay? Let's just assume so. And that's true for a lot of the income. So I think I understand Alicia's concern. What happens if it's like a flower, it takes 10 years? I don't think we'll have that concern with a lot of what's referred to, okay? So see if this works. So that's what this revenue ruling stands for. That if you give away a tree with ripe fruit, you'll remain taxable on the ripe fruit. And it offers two different cases to help illustrate this. Okay? On page 291, in italics. Well, it's not in italics. It's on the second paragraph. It talks about Campbell v. Pro, right? Okay. An older case talks about someone giving calves, part of a herd, to a charity, and whether or not they should be taxable on this. Had the calves, essentially, had they matured into income? And the answer was no, they had not matured into income. Okay, so it was not considered taxable income. Okay, because this revenue ruling would lead to the conclusion that the calves had not yet become ripe. Okay. In contrast, on page 292, the first full paragraph on page 292, of course, after the indented language, Tatum, they own land, and there is crops, okay? And here the taxpayer landlords, upon receiving the crops, immediately transfer them to a charitable donee who sold them in the same year. The question is, should the taxpayer have been taxable on the harvested crops? And I think you know the answer to that. On page 293, the first full paragraph on 293, the second sentence. When the crops are harvested and delivered, the landlord has been paid in kind for the use of his land. Crop shares representing payment by the tenant for the use of the land or rental income no less than money paid for the same purpose. And essentially said, hey, harvested crops are ripe, right? They are ripe, and as such, they should remain taxable to the taxpayer because they had ripened already on the taxpayer's hands. They were not green apples, they were red apples. When it comes to stock dividends, when is the appropriate time for who should be taxed on stock dividends? Is it the declaration date, the record date, the payment date, the date of actual receipt? Of those dates, what is generally considered the right date for when someone should be taxable with respect to dividends? The record date, right? Everyone agree? The record date. Because at the time, if you own stock on the record date, your right to income is matured, right? And you should be taxable on it. Go on.
What happens when there's endowments? So
There's what?
endowments. So I give to a charitable organization stocks,
Right?
and I tell them you cannot sell the stocks. You can only take the earnings of that stock or the appreciation. But then 10 years later, because there's usually like a 5% provision or something like that, they do take some money out. Would that mean that my
I think what you're referring to, there's, under Code Section 664D, there's something called a charitable remainder trust, charitable uni trust, CRAT and CRUT, charitable remainder annuity trust, charitable remainder uni trust. Because you're treating it de facto charitable, where under both of those you have to have at least a 5% payout. I think those are the code sections you're referring to. There's very special rules when you make a donation to a charity in which there's an expectation that the money's gonna be held there and you're gonna receive money back. I think that's what you're referring to, John.
Well, kind of, it's the same, well, let's say I give $1 million. I don't have them now, but I guess at some point I will. I give up $1 million to an organization, I tell them, you cannot use this $1 million. You can only use whatever you earn from this $1 million up to 5%.
But, I mean, if you've given it away, you're gonna get a charitable deduction. Do you have any right to get it back?
No, but in the sense they're not right, because those $1,000 are not being used.
I think that's a moot point at that, because we can talk about it more, John, but I don't think, that's not, things that we're discussing in the class pertain to somehow you or a non-exempt entity have a right to income. When we start getting into exempt entities, I think that will move several of the issues. So, because the sum of income to a charitable entity, unless they have something called unrelated taxable business income, that's Code Section 511, it's moot. Most charities don't pay tax except with respect to UBIT, so-called UBIT income.
Well, what I'm referring to, me giving the money away, I'm not the charitable organization. I bought something for $200,000, it grew up to $1 million, I give it to a charity.
You give it, but again, you're not gonna be taxed on that unrealized appreciation. You will not be taxed on that $800,000 embedded gain. You'll get a deduction for $1 million. Ashley?
So I'm just, when you say if I have an apple tree and it has ripe apples and I give that tree away, and then let's say I give it to Jessie, and then she sells, is it when she sells those harvest apples that it's taxed? I mean, is it taxable to me for giving her the tree?
It's taxable to you, not when you give her the tree, when she recognizes income. Right? Hold that thought, Ashley. Let's go through the problems and let's see if I can put it to bed. I'm not sure if I can, but let me try. Right? So let's look at the problems on page 294. Father owns land which he purchased several years ago for $80,000. Has a current fair market value of $90,000. Father leases the land on a 10-year lease. Has paid $6,000 rent each year, semi-annually, April 1st and October 1st. Okay? For the prior 6 months' use of the land. Okay? What are the tax consequences of the father or daughter in the following alternative situation? So, just bear in mind that this is a 1-year period. There is rental payments semi-annually of $3,000 on April 1st. We'll make this July 1st. April, $3,000. July and October. And this will be year 2, just if we need it. April 1st. July and October. On April 2nd of the current year, and this is the current year, right? This is 2016, let's just assume. On April 2nd of the current year, father assigns daughter all the future rental payments, okay? So the question is, in 2016, who gets taxed on the $6,000, right? Who gets taxed on the $6,000? So, Fausto, Diana, who gets taxed?
For the bottom of the taxes, is that?
Diana, agree or not?
The first payment will be taxed to the father and the second to the daughter.
Okay, daughter, Nick, agree, disagree?
Agree.
With whom?
The second answer.
Diana's answer, Jesse? Jessica, I'm saying.
What was the second answer?
Second answer is father 3,000, daughter 3,000.
Agree with the second, because it already accrued.
Just say it loudly, Jessica, a lot of people.
Agree with the second, because it already accrued. Part of it.
So there's nothing right? The rental payment, the second payment isn't right? Until time elapses, the second payment is not accrued, right, Mike? So who gets taxed?
The father was taxed on all because the property wasn't given, just the rental payment.
What's your authority?
I mean the concept.
But you have authority. Wes, any authority? I think you have better authority. Nadia? Raphael? You good? Is this Helbring v. Horst? If you keep the property, but give away the rental income, who gets taxed on it? You get taxed on those apples, right? Diana? That would remain taxable on all 6,000, right, Fausto? Helbring v. Horst, right? He kept the tree. The tree keeps producing red apples, right? He gets taxed on it. Don't fund it, follow the money. This is not the Jerry Maguire school. You can't follow where the apples are going. Alicia. This is not services, right? This is not the performance of services.
So even if the father is still the owner of the land, doesn't that make a case that he's the one actually renting out the rental? Therefore,
He is earning it, but he gave the future rental payments to his daughter, but he kept the land. So it's like keeping the bond and giving the interest coupons to someone else. That doesn't apply, right? He remains taxable. All right, everybody agree?
so who's taxable then?
The father.
The father.
The father remains taxable all the time. All right? On April 2nd, father gives his daughter the land with the right to all future rental payments. All right? In this case, Johnny and Luke, what do you guys say?
Taxable to the daughter.
Tax to the daughter, Luke, agree or disagree?
I agree.
Okay, what would your authority be here?
Blair?
Yeah. You give away the fruit of the tree. So the father would be taxing the first 3,000, right? He got it. The second 3,000, the daughter would be. How about on April 2nd, father gives daughter 1/2 interest in the land and the right to all future rental payments.
So for B, wouldn't the daughter take all 6K?
Well, remember, on April 1st, the dad already got 3,000, right? And that was, if you see the phraseology, it says for the prior 6 months of the use.
Okay.
Alicia.
One question. What is interest in the land?
Interest in the land is ownership.
So he actually gives her half of the land.
He gives her half the land. It's a 1/2 interest in the land. So in this particular case, Jackie, Ji Ying, what do you say?
For C.
This is for question C. Who gets taxed on what? And Ari, feel free to jump in. Jackie, you want to first dibs?
Still split because of April 2nd.
So who gets taxed on what in 2016? Just give me numbers.
father 3, the daughter 3, but I don't know, are they supposed to split the second half if it's only half of the land?
All right? Oh, meaning the father will get a check for $3,000 payable to him April 2nd, April 1st, right? Everyone agree? Dad's happy, gets a $3,000 check. Okay? Daughter will get a $3,000 check in October. Who gets taxed on what? Jackie?
Do they split it, like the daughter?
Well, just give me numbers, because I'm the client and I'm dumb. I just want to know, give me your numbers, I want to fill out the tax.
Father 1,500 and the daughter 1,500.
Okay?
She only has half interest, but I don't know, the check went to her, so I don't know.
You're not sure?
I'm not sure.
Jay-Yang? Gotta give me your shout voice.
Yeah,
Not sure? Ari?
The daughter 3,000?
I'm sorry?
The daughter 3,000?
The daughter 3,000. James, agree or disagree?
Isn't that half? Yeah.
So you tax dad on 3,000, daughter on 3,000. Serena, agree, disagree?
Agree.
Karen, final word?
I'd say the leaning more towards 3 and 3 versus the 4,500, 1,500.
Are you whispering or are you talking to yourself?
I said I was toying between 3 and 3 or 4,500, 1,500.
And where do you?
I'm gonna side with 3 and 3
You're going to side with 3. You're going to split the baby in half.
too. Yeah, 3 and 3.
Is it a good idea to split that baby in half, Larry? Dave's saying no. Dave, what would you do with that baby?
I would get split 15-15 because he still owns 50% of the.
Yeah, I mean, Dad still owns half the tree, right? So because Dad owns half the tree, and Jackie, that gets to your point, Dad remains taxable as to 1/2 of the income. So the dad gets taxed in 2016 on $3,000 plus, even though the daughter gets the full $3,000, right? In October, Dad remains taxable as to half because he still owns half the tree. So Dad's taxed on $4,500, daughter's taxed on $1,500.
What would we call the authority on that?
I would use Blair again. Question D. Father owns an income interest in a trust which owns the land. Okay? So, get the visual? There's a trust, not the father who owns the land. The trust owns the land. And on April 2nd, father gives his income interest right to the succeeding rent payment to his daughter. Right? So the father, vis-a-vis the trust, got paid $3,000. And now the daughter, vis-a-vis the trust. Matt, Alicia, who gets taxed on what?
Father, the 3,000 initial, and daughter for 3,000.
Father, 3,000, daughter, 3,000, Alicia, agree?
I agree. And because father gave away everything he had, the whole interest.
Okay, let me just ask Alicia, do you have authority for that?
Could be Blair. I would say Blair because he's learned to give away everything.
Okay. Blair would be the authority, right?
Unless it's another case.
No, Blair will work here.
Isn't he keeping the interest in the trust? He's just giving away the income?
That's all he owns. He only had the income interest in the trust.
Oh.
So
All
what
right.
is the,
You can ask whatever you want.
what is the difference between Halbering and Horst versus Blair and Commission?
Halbering v. Horst, they kept the tree,
They have-
meaning the bond. And Blair, the person gave away the entire tree.
Oh.
Okay? And I know sometimes we overuse the metaphor, right? We push the limits, but it is what it is. Louis, you got that?
Yeah.
December 31st, coming up, right? Everyone's marked their calendar. Anyone have anything exciting December 31st planned? Celebrate the end of tax. Andy, what do you have going on?
It's my 25th birthday.
It's your 25th birthday. You were born. Your parents got a deduction for you.
Yep. My dad was very happy.
Fit that in. Okay, good tax planning 9 months early, right, Ashley?
My dad's a CPA too.
All right, wow, he has a lot to, just tell everyone in the office, look at him. All right, come on.
I guess you were January 2 or 3, and he was like, nope, December 31st it is.
Yeah, I was born like 3 years early actually, January 20th.
Get me out of here, right? All right. Question B? D. Question D is that the father's tax on the first $3,000. In question D, the daughter would be taxed on the entire $3,000 on his second payment. Okay? Question E. On December 31st, father gives daughter, New Year's Eve, the land with the right to all future rent payments. Okay? Everyone got that? So father gives the daughter, right, the property right there. Okay, everyone agree? All right. So we know in 2016, dad is going to be taxed on $6,000, right? No one's falling off their chair on that one. Question is, who gets taxed in 2017 and then how much, right? Evelina, Michael, what do you guys say?
I'm gonna say that he's taxed the percentage for the months that he still owns.
Just say it loudly, so give me numbers.
December 31st, the April 1st payment is what we're talking about.
We're talking about all of 2017. Client comes knocking. What should I report in 2017? And you say?
45. Now that 15 for the father.
You represent the father. You say how much?
Of the 2017,
1,500. Michael.
I'll say 3.
Dad should report 3. Daughter should report 3. Annetta?
Dad 0 because he already gave away.
So how much should the daughter be taxed on 6? You're saying, huh? 6. Let me ask this, Alicia. What do you say?
I say that father on 1,500 and daughter 4,500.
1,500, 4,500. Matt, final word?
I would have said that at the first payment date with the daughter, so like on April, next April.
So in 2017, how much does the daughter and father report?
245.
What's your authority for that, Matt?
That picture right there.
That works hard. All right. This is coming from the revenue ruling 69-102. Because as of December 31st, everyone agree? Half the apples are ripe, right? Everyone agree? At the time dad's making a gift, half the rent isn't due, but it's accrued. Everyone agree? At $1,500 of the rent as accrued. And the other $1,500 accrues in the daughter's hands. And as we said, in terms, when the other Alicia we spoke, but it's not taxed by the dad when he gives it away, rather when the fruit is harvested or paid here. So under the authority of revenue ruling 69-102, daughter would be taxed on, for 2017, $4,500, and the father would be taxed on $1,500. Right? Questionnaire. Father sells, on April 2nd, father sells daughter the right to 2 succeeding rent payments for $5,000. Their fair market value in time of sale. Okay? So, father, April 2nd, sells his daughter the rights to the next two succeeding rent payments. Okay. Who's taxable on the $5,000? And this should remind you of what case, guys? The Stranahan case, right? And assuming Stranahan is good law, which we know nothing to say. Alicia?
Do you think if he wasn't dismissed, the outcome of the case could have been different?
If what happened?
If Stranahan wasn't dismissed, that the outcome of the case.
If Stranahan wasn't what?
If he didn't die.
No, the outcome should be the same. Because when someone dies, theoretically your estate just assumes your role. So whether he had lived or died, the only thing is maybe the court felt more sympathetic. But I don't know.
That's what I was.
I don't know. But can't go there. All right. So in this case, guys, for your answers, under the estate of Stranahan, I think it's fair to say that the father would have commanded $5,000 worth of income, right? If he had sold it to his daughter, she would have a $5,000 tax basis, so she could amortize the next two payments and essentially report $500 of income, $500 of income, right? Because she has a $5,000 basis in this right to future dividends that she could amortize over this year and next year. So your answers, not to make your notes too confusing, Dad should have $5,000 worth of income, and the daughter in 2016 and 2017 presumably would have $500 worth of income and another $500 in 2017. Agreed? What's my authority? State of Stranahan.
Okay, I'm confused. So if he would sell it to somebody else other than daughter.
I think he could sell it to the daughter was treated like an unrelated party.
Oh,
So
okay.
the fact he sold it to the daughter has no bearing on this. He could have sold it to me. But in fairness to Alicia, anytime you hear a related party sale, your antenna should go up, right? Because maybe Code Section 1239 applies. Maybe 267 applies. Maybe some funky provision. So anytime you hear a sale, get nervous if it's a related party. Yeah.
Doesn't the fact that he sold it on the second have any bearing? Because
No,
at
I
that
think
point it
it's
was already worth $6,000.
No. On the second is worth zero, right? No rent has accrued.
Oh, right.
So Nick, it's clean.
But he would pay tax on the first.
He already got. He's going to be taxed on that first.
Okay.
Question G. Father sells the land and directs that $90,000 worth of the sales price be paid to his daughter. Okay. Sells the land and directs that the $90,000 sales proceeds. Who gets taxed on that? Okay, Luca?
The father, Lucas B. Earl.
Okay, do you want to cite the Lucas B. Earl? David?
Over reverse.
Well, in this particular case, he sold the property. He could even cite to, even though the fact pattern is distinguishable, but cite for the authority that it is distinguishable. Here, the father had truly sold the property, so under Susie Salvatore, whoever sells the property should be taxed on it, right? Doesn't matter where the proceeds are directed, agreed? Lucas B. Earl is really confined to services, right, David? That's the reason I'm shying away from it a bit. Although I have to say, David, anytime we get into an assignment of income case, inevitably, virtually every court will cite the Lucas B. Earl and inevitably somehow mention fruit and trees. So just be forewarned.
But can I come back to the address?
Question F, yes.
So father pays on 3,000 plus 5,000. Yes, it's gonna pay the tax.
Yeah.
Here. Okay, that's it. Thank you.
Okay. Question 8. Father negotiates the above sale on April 2nd. He transfers the land to daughter. He transfers the land to buyer, who pays the daughter $90,000. So if dad had negotiated the whole shebang to here, who gets taxed?
The father?
Yeah, the father. What's our authority for that here? Say again?
Salvatore.
Salvatore. right? Yeah. Is that what you said? Yes. Susie Salmon, right? And let's just go through questions 2 and 3, and then we'll take a break, guys. A little late, but later sooner than not. Who's taxing the lottery winnings below? Ed. Lucky purchases a lottery ticket. He gives a child prior to the lottery winner being announced. The ticket is the winning ticket. Okay. Who's going to be taxed on the proceeds? John, Jesse, see if you agree with John.
I would say the child.
John, Jesse, agree? Disagree? Say it loudly. Disagree. You said yes. And Dave, who's right?
I would say that the dad is because he bought the ticket.
Say again?
The dad is.
The dad is. Why?
He's the one that bought the ticket.
Just say it loudly.
He's the one that bought the ticket.
Okay. Any strong opinions? Who says dad? Hands up. Who says daughter?
Howard's child?
Well, put it aside the kitty issue. Karen?
Well, no, I'm gonna keep it if they're under 18, so.
No. Just don't make it that easy. Rena, you were going to say something?
Wouldn't it be the child because he gave the child the ticket before it was announced?
Yeah, and by the way, in the office I used to work at, that you have a bunch of tax people, and every time we would buy a lottery ticket, they would go around and get it notarized. They assign the interest to their child beforehand, and it would be notarized. No one ever won, but we could have the formal procedure, because as long as you do it before, it is effective, okay? It's just worth $1, right? And you can give away that property, and if it grows, that's like giving away something like a piece of land that you didn't think has oil and it's worth $10, and then it has, it's worth $100,000, right? You don't get taxed on it if you make the gift beforehand. There's no knowledge of that.
And if the child is under 18, you still can manage the money, yeah?
Well, you can manage it, but then the kitty tax would probably apply and you'd be taxed on it. So, it doesn't work as well. So the answer is child gets taxed in question 2A. Question?
Based on the gift.
Well, it's an effective gift, right? Question 2B. Same as A, except that Lucky's gift occurs after the lottery winner is announced. Too bad, right, Nick? Doesn't cut it, right? Parent would be taxed. Agreed? Not surprising. And I know sometimes they announce like the, Powerball winner, and they say, well, they're still trying to figure out among the family members who won. That's a little bit too late to figure that out, guys. Okay. Question C, Lucky wins the lottery but properly elects to be taxed on the lottery winners in the form of annuity over 20 years. After 2 years of annuity payments, Lucky gives the remaining 18 years of payments to the child. Who gets taxed? Now, I know what you're thinking. I know many of you are thinking, gee, this is someone like Blair, but virtually every lottery winner has this ability, right, to take a lump sum, right, or to stretch out the payments. Agreed? And the IRS in many, many rulings say that once you have the right to the whole, okay, you cannot take it as a stream of income and then assign it away to a lower income tax bracket taxpayer. So Blair would not be affected here. The taxpayer would remain taxable on the whole. Okay? Why? Because unlike Blair, here there was an election you could make where it could have all been taxed, but you chose not to. You had control, just like they say the power to control money is the equivalent of ownership of it.
But doesn't the same apply when you put money from the trust? You
don't know. Money from a trust, you can never demand from the trust, I want the entire thing paid up front, right?
Okay.
You said that with the lottery, even if you pick annuity payments, you can go back and ask for the form.
No, once you make an election, it's irrevocable. You cannot change your mind. Not to say I'm an expert at lottery winnings, guys. Okay, if you want to pick the losing ticket, follow my numbers. Okay? All right. Question 3. Inventor develops a new electric switch which he patents. Who's taxed on the proceeds of its subsequent sale if the patent is transferred gratuitously to son who sells it to buyer? Okay? The patent is transferred gratuitously to son. So normally, right, we know the son normally takes over the basis, he can sell it, and assuming it's not like Susie Salvatore, where there's a pre-existing sale, that's going to result in the son picking up the income. But what the authors are trying to say, or call to your attention, is usually here we have an inventor. What do they do to develop a patent? They work day and night, right? A lot of services, right, to perfect the patent. Agreed? And everyone use their nose and take a deep breath, and you can smell it. It smells like the rendering of services, right? And that should come to mind Lucas Bureau, right? The rendering of services. And who gets taxed usually on the rendering of services, we know? Usually Lucas Bureau, whomever performs the services. However, you can take your services, and here it's transformative, right? You've taken your services and transformed it into intangible property, right? You've made it into a piece of property known as a patent. Agreed? And normally, if you give away a piece of property, right? And again, assuming there's no pre-existing arrangement like Susie Salvatore, who picks up the gain? The donee. The recipient of the gift, right, picks up the income. And the answer in problem 3A would be the mother gives it to her son. The son would be taxable, okay? The son would be the taxable party, even though you might think, gee, the mom is the one who performed all the services, but there's been the transformation of those services into property, and therefore, I'll say the normal rules of property would control here. So section 1015, where the embedded gain is taxable to the person selling it. Okay, everybody agree? No one's lost on that. Just the property rules, not the service rules apply. Question 3B. Inventor transfers all of her interest in the patent to buyer for a royalty contract, and then transfers the contract gratuitously to son prior to receiving any royalties. And here again, we have something similar here. The mother has a right to royalties, but it's with respect to property. It's not her services because it's been transformative into a patent, and that's a piece of intellectual property. And just like in Blair, if you give away property and you give the entirety away, who gets taxed on the stream of income flow? The recipient, right? Because the mother has not retained any interest in that property, right? She's given away 100% of her interest. Who then would be taxable? The son. Okay, so why did the authors raise this towards the very end? They just want to call to your attention that it's not potentially as straightforward as one might initially think. It's not as straightforward as one might initially think. Questions before we take a break?